Okay, welcome everyone. We'll start our second unit, which is Financial Accounting 2. My name is Anjum Satar and my email address anjum@ukversity.co.uk. If you have any question, please drop me email on my email address. In first lesson, we'll go through our LO1 learning outcome 1. Before starting today's lesson, we'll go through what we're supposed to learn under this module, this new unit, and we'll check the aim of this unit to develop ability to prepare the financial statement according to international accounting standards for small and medium sized entities, which is the entities mean organizations. So we'll go through sole trader, partnership, and companies accounts as well. And today lesson we'll go through LO1. We have 4 LOs, 4 learning outcome, and today lesson we'll go through LO1, and we have 3 assessment criteria: compare, explain, analyze, and assess. So which we'll go through today lesson. So in this lesson we have an inductive content, what we're supposed to be learn under capital structure of different organization to include sole trader, partnership, limited company, manufacturing company, not-profit organization, and combination of companies. So all this will go through today lesson. And then financial reporting, different organization, how they prepare the reports, how they report to the various stakeholders. So all this will be focused in today lesson. If you have any question, please drop me email. If you're listening this recording, drop me email on my email address anjum@ukversity.co.uk. So we'll start. So as I mentioned, we have 4 assessment criteria which we will go through to cover this learning outcome LO1. So identify similarities and differences, compare. So when you've been asked to compare something, you have to identify the similarities and differences. Explain. So what is meant by explain? If the command verb we use explain to give accounts of the purpose or the reasons why financial accounts. What are the reasons why company prepares sole trader, partnership, and limited companies? Analyze. So we need to analyze the information, separate information into component, into different parts: current asset, non-current asset. What are the benefit if we have a more current asset than non-current asset? So advantages, disadvantages you have to discuss. So assess, offer a reason and judgment of the standard and the quality and the situation and the skills informed by the relevant facts. So we need to look around the relevant fact, whatever we've been given, how much is true, and we need to be information. It need to be financial information. Always financial statement should provide and true information to stakeholders. Stakeholders mean anybody who has any interest in the business is called stakeholder. Shareholders mean any investor. So inductive content, which I mentioned you as well, which we're supposed to go through today lesson. Okay, compare the capital structure of different organizations. Sole trader. What is meant by sole trader? Anybody knows what is meant by sole trader? If you want to start a business, you can start a business as a sole trader. 1%. 1% business. Like a corner shop is a sole trader. Partnership can be 2 to 20. How many? Minimum 2, and 2 to 20 it can be partnership. So we have in the UK Partnership Act 1890, which is govern how partners, and so this sole trader unlimited liability, 1%, all the risk and reward bear by 1%. Partnership is sharing, and we can decide the ratios between partners. And limited liability is a limited liability as the word. Nobody can claim against your personal asset. Like if you start a business, you borrow money, but the business default, you can't really sustain in a business. So nobody is really going to ask the money to be recovered from your personal asset, such as a property, such as a car, and various other your assets. Accounting is a way of recording, analyzing, and summarizing the transaction of entity. Entity mean organization. Either your business is a sole trader, partnership, or limited company. So this all come under these, these are also known as a type of ownership. So you can be a sole trader, you can be a partnership, you can be a limited company, you can start a business. Different types of organization. Next is a non-profit organization such as charities, clubs, societies, government, NGOs, non-governmental organization, NGOs. All this they work for the welfare of society. Regulated charity is regulated under the Charity Commission, which is 2011, the Charity Commission Act, we need to be follow, and the accounts need to be submitted into the Charity Commission. So charities are regulated by the accounting standards, charities law, relevant companies laws, and the best practices. So charity, they have to produce the accounts. So what sort of account? They have to produce the financial position, which show the how much worth of the asset, how much worth of the liability, how much worth of capital investment we have in a business. So a statement of financial activities that can show, how much we have financial activities. So which can be shown in account reports for the Charity Commission, and sometime income and expenditure account we have to submit as well to Charity Commission. So these are prepared in line with the statement of recommended practices, SORPs. In other countries, requirement will be different. It varies according to the international the local accounting standard. Different limited liability companies, it means the limited liability, no one can be claim the money against no one can claim the money against your personal asset, because if you borrow the money from the company, you're a company director, and nobody can claim. They can only claim against the company asset. Disadvantage: compliance with the national legislation, because lot of disadvantages can be lot of legislation we have to be follow, and it's costly process as well. So owner shareholders can be owner in the business, those are called shareholders. Owner managers can be split, and board of director can be select based on the voting right. Funding: so return profit, share capital, short term liability, and the loan note, we can get the money and we can raise the money. Okay, partnership, as I mentioned earlier, partnership is the agreement between the two and more individual in they undertake the share, risk and reward as the joint business operation. So advantages: sole trader versus spread risk, network of contract partners bring into business skills and experience, easy to raise finance. If you bring five and 20 partner, they can easily bring 100,000 in the business. So we need to be think about it's easy to raise, because and different partners can be invest different proportion of the investment as well. Profit can be spread, control relation can be control, can be dispute between the partners. Sometimes is a conflict of interest. So it can be a partner is in a salary, partner is working, partners have some is coming on time, some not coming. So that create sometimes is a conflict in a partner. So we have advantages, we have a pros and cons. Yes, advantages and disadvantages. Anybody any question? Please, if you're listening, listening this recording, drop me email if you have any question. Company Act 2006, which is regulate the company in the UK, and the company need to be registered. If you want to set up the company in the UK, you have to go through the company's house. Where you have to go? companyhouse.gov.uk, and you can register by paying the registration fees, which is approximately £25, which is carry on changing. So it's good to be checked well before. Then the company house, where you can declare how much worth of the company will be, where your registered office will be, memorandum, who will be responsible for what the company's mission, and reinstatement will be how much the registered or nominal capital will be for the company. So all this, if you want to be start private company, can be two types: private limited where the private investor, and public limited. If you want to be start a company as a public limited, we require minimum £50,000 worth of the investment to be registered as a public limited company, such as Unilever, such as Procter & Gamble, such as various other company like Morrison, Tesco, Asda, the supermarket, all are public limited company, own the shares to the public. They are listed in the stock exchange. So those we need to be look around. All the UK registered company must be comply with the Company Act. The Act man required the director must be prepared and approve the annual account and circulate them into the shareholder. The account must be filled in the registrar of the company. Quoted company are prepared IFRS, International Financial Reporting Standard, IFRS. So how we can report. Other company prepared the company's account according to the UK standard, which is known as IFRS, we known as in the UK FRS, Financial Reporting Standard. So all these accounts should be true and fair and comply with the IAS 1, International Accounting Standard 1, which is about the presentation and preparation of the financial statement. Okay, next now we look at the limited liability partnership is a key advantage of you have the partnership, but you can register this partnership in the company house, then your liability become a limited to your investment. And most of the solicitor firm and other brokers, they have a limited liability partnership, so nobody taking more than the investment, the liabilities. Okay, any question? If you have any question, please drop me. So we learn different types of ownership: sole trader, partnership, limited company, and charity. So these are four major categories of types of ownership. Either your manufacturing company, or we can prepare different accounts under different types of ownership. So if we are a sole trader and partnership, we can prepare the profit and loss account. So if you're a sole trader, you're preparing the sale, profit and loss account. Four types of the statement that we prepare in account. So sole trader, statement of profit and loss, which is also known as the income statement, statement of financial position, which is also known as balance sheet, statement of cash flow, which is also known as a cash flow statement, and the last not least is called the statement of change in equity, how many shares we issued during the year, which I'll go through all these today lessons as well, explain you. So statement profit and loss, which is also known as the income statement if you're a sole trader, sales, cost of sales, how much worth of the goods. If you're a manufacturing company, you're manufacturing internally where you're using direct material, direct labor, and you can prepare the account. Then sales, then what cost you. If you minus it, you get the gross profit and less other expenses, which is meant by overhead, and we get the profit. Then all this belongs to the sole trader. Of course, profit, and this profit we have to pay the tax. After tax is all yours. If it's a partnership, your sales, cost of sales, gross profit, lesser then you have a profit. Now we need to decide share between the partner according to the partnership agreement. So next now, if you have a partnership agreement and you need to prepare is called profit appropriation account. Allocate partner salary. If you have a partner salary will be expense for the business. You need to be minus from the whatever the profit came through the normal operation. Allocate the interest on capital. If you paying interest on the capital, the money their partner invested, you minus as well. Allowed commission, if you pay the commission to the partner if they are working in the business as well, you minus it. If the partner draws some money and you charge the interest, that's the income for the business, you add it. And then whatever left we distribute between partners. Like here, we'll say their profit we have for the business from the business is 26,000. Partner A, partner B, partner C. We have three partners. So partners getting the salary we minus it. Then interest on capital we minus it, which is expense for the business. Then a commission we minus it. Whatever will left after this. So this is the residual profit. The profit is left. Now that profit will distribute between the partners. Partner A will get 40%. We already agreed between us, what the sharing ratio will be. 40, 40, and 20, because that makes 100%. So 17,000 divided by 100 times by 40. So that goes 40%. That goes 20% and 40%. When you add them all, it's the same. So we distribute this, and this will be goes into partners current account, which is we can open within a business, which we'll go through further. Anybody any question? Okay, next now the statement of balance sheet. If we are preparing the, or we also known as a financial, if you're a sole trader, you're just preparing the proprietary interest, capital, profit, and drawing. If you're a partnership, you have a capital accounts where the partners capital how much invest, and the capital accounts, and we also prepare their current accounts. So partnership and the partnership current account when added is equal to the same. It's all meant by the same, but we can divide into. Okay, so capital account like a balance brought down, partner is partner B's. If they getting the current account is mean how much money they have previous year return earnings. So we can add there, and salaries goes interest on capital and share profit this year. So that's whole the partner A and partner B if they have a drawing. So what is the balancing figure? What the net amount they have? The because drawing is something you draw for personal use. So that's called drawing. Okay. Sometimes the partner can be leave, partner can be join. If you start a business 10 years ago and the new partner join you now because you develop the goodwill, if they say, we'll all share equally now. So because you joined a lot of years ago and you develop the business at the goodwill, so that goodwill can be divided and the goodwill is the asset for the business, which is called intangible asset, don't have a physical substance. So like we have a property, we have other assets, we have a total, we have a liabilities and net assets. So the business is therefore the book value is 220,000. However, the business is valued whole the worth of the is 350. So the difference between 130 above the book value, which is called is a goodwill. That goodwill we can distribute between the partners according to the old ratio. So what we'll do when we'll create the goodwill, first we'll do the debit the goodwill, credit their capital according to the old sharing ratio between partners, whatever the partner ratios we decide. Okay, then when with the new partners enter, we'll do the debit their account with the new ratio and credit the goodwill account now, because we create the goodwill, we eliminate the goodwill won't stay there. So that's the new partner join, and then their account will be affected and we can prepare. So is a sole trader, we can prepare different ways layout, the statement like I mentioned you earlier as well. Any question? Okay, next now financial statement. So balance brought down in individual nominal accounts and then initially primary balance and errors if we have any, we can prepare the workings as well. Okay, the cost of the goods sold. If we had a manufacturing account, so we need to be find the cost of goods sold. So opening inventory plus purchasing during year minus closing inventory. So we can find, and the cost of the goods sold is goes in the profit and loss. If even we are a manufacturing company, we can calculate the cost of the goods sold or the cost of the goods manufactured within the company. Okay, IFRS International Financial Reporting Standard Preparation and Presentation of Financial Statement. As I earlier mentioned, we prepare 4 types of the statement: statement of financial position, statement of profit and loss, statement of change in equity, and the statement of cash flow. And we have a notes. So always guys, good to be read the notes, which I'll go through 2 companies financial statement, and you will see in last our learning outcome, our assessment criteria 1.3 and 1.4. Okay, so this is the pro forma under IAS 1, International Accounting Standard 1. It's according to this standard, is main purpose of this standard to reduce the headings. You will see there will be few headings. So revenue is also known as sales, turnover, revenue is the same thing. So with 2 years, always good to be prepared 2 years. Cost, how much is the cost? Gross profit, cost sales minus cost of sales equal to gross profit. Then we have administrative expense, and all sort of expense overhead we can distribute into 2 heading: distribution and admin. So admin can be stationary, admin salaries, Distribution can be warehouse, distribution costs, all these, we can include under, and even the depreciation we can decide under which heading, either goes in the cost of sale or either goes in the distribution or ad cost. We can proportionate it, the two department use. Then finance cost is the cost on borrowing money. So if you borrow money, you have to pay interest is known as a finance cost in the business. And then we have a taxes. If we that taxes will, and then is a profit for the year. That profit we can distribute between the shareholders in shape of dividend. We normally not distribute all. And when you prepare the balance sheet under the IAS 1 or International Financial Reporting Standard, so you can put the key heading first, always non-current asset, intangible come first, then tangible asset, property, plant, equipment. All we can merge asset into one heading. Current asset, then we have a normally inventory, trade, and other receivable. It can be prepaid as well. All we can put it other receivable. Cash and cash equivalent meant by cash in bank, cash at in your locker, and we can add is all my total asset. Total asset we minus our liabilities, so we'll get net. So we have equity, share capital, share premium. Share premium means more than the nominal value of the share. If the share was £10, actually in demand is very high, you can sell it £15. So £10 goes in the share capital, £5 goes in the share premium. Return earning means the previous year the profit was not distributed between the shareholders. Every valuation, it means the asset was £100, you bought it, but now is 150. So increase the value of the asset, increase the revaluation surplus. So value is increased, value can be decreased as well. So bank loan is a liability which is a non-current long-term liability. We have a current liability, trade and other payable, which is also known as the creditors. We have a short-term borrowing, we have a tax liability, and then all these, and we have a total liability. If you have any question, you can drop me email. Anything you not get. So notes is very crucial to read notes to betterly understand, what these figures, where these came from, which is it is required by IFR, International Financial Reporting Standard. You give clearly indication where these figure in the notes, full details. Accounting policy, accounting and the disclosure accounting policies adopted by the director of the company, and company should select the accounting policy give true and fair of the financial performance. Company not allowed to change the established accounting policies without the giving good reason why we want to be. Whatever the costing method you use, you have to carry on using the same. We have a different other accounting standard as well, like such as IFRS, International Financial Reporting and International Accounting Standard 16 is about the property, plant, equipment, how we can depreciate, straight line, diminishing, and which period to which period. So these all come under the IS 60. And then inventory evaluation. Think about the Windows 98 software CDs. We bought £200, but now if you want to sell it, how much is the real value of the Windows 98 CD? Maybe people are not even willing to buy more than £10 to pay per CD. So we should revalue our inventories according to the cost or the market value, whichever is the lower. So we paid 200, but no market value is at 10. So we should record inventory at £10 each CD, not £200, because we are not telling the true story to the people. So that's why we have to revalue our inventory accordingly. So element of financial statement: asset, anything you own it is called asset. Liability, anything you owe it. Equity mean the investment. Income is increase the economic benefit such as a profit. Expenses is decrease your economic benefit because your cash is going out of the business. Contribution, and which increase the equity if you invest more money in the business. Distribution to the owner, yes, decrease the if you withdraw the money. Okay, next now we're looking accounting equation is equal to asset minus liability equal to net asset. Net asset always equal to equity. Equity mean is the share capital, the investment in the business. So what make equity? The opening capital, opening plus your and if you have other expense, you minus it, of course, like a drawing you draw for personal use. So that's equal to equity. Recognize the element in the income statement, recognizing in the accounting equation that profit goes also part of capital. Any question? Okay, next now we have 1.1M, which is the merit criteria to address it. So accounting policies we have, uh, principle going concern, the financial statement must be prepared on the going concern basis unless entity is not going concern. Accrual is known as a matching concept. The financial statement must be prepared on accrual basis except the cash flow of the information. Materiality and aggregation, each material clause for the similar item must be presented separately. Item as the similar must be presented separately and they cannot be aggregated unless they are the individually immaterial. So offset, the asset and liability and income and expenditure should not be offset unless it is required and permitted by the standard. So you can't offset from the balance sheet. It should be shown in the balance sheet as long the international accounting. What is the likelihood? Like we have a court case again, the Facebook, and the Facebook highly likely the case will be against them. So this is called contingent liability. Is 60% likelihood this will be the case again. It should be shown in the financial statement because we need to be tell the true story to the user of the financial statement. Consistency of the presentation, yes, must be a consistent policy. Don't need to be changed. The costing methods and things, so it should be. Okay, this profit and loss under IS1 is the revenue, cost of revenue, and it's removed there. It's a limited heading like I mentioned in the previous as well. So now we can assess. This is the statement of change in equity, which will look in the share capital, other reserve, return earning, and total equity at the start, total equity at the end, how much dividend we paid, how much profit, how many shares we issued during the year. Then the cash flow statement we prepare under IAS 7 International Accounting Standards 7, which is about the cash flow. There are two methods, indirect. Direct, we have a three headings here under the cash flows: operating activities, investing activities, and financing activities. So how many activities under IAS 7 cash flows? The cash generated by normal business cash through extra, you have an investment in different businesses, and you borrow the money came in. So you can start profit before tax, and then your adjustment you can look around and make it, and these adjustment, and then you will get the net cash from operating. Then we can start with the investing activities, how much increase and decrease in the value of the asset, how many assets we sold, how much interest, dividend you receive. So then you can find the net increase or decrease in the cash under the investing activity. Then financing activity, and at the end of the year, how much the cash we have. So this is always good to be compared and look around the cash flow statement, which is a very crucial. The cash is the lifeblood of any business. If you don't have a cash, you don't have a business. Anybody, any question? Any question, guys? If you have any question, drop me email, please. If you're listening this recording, we'll go through now. Next is a very popular and quite big organization. So now we'll go through the next financial statement. So what we need to do, copy this link, open the financial statement of next. So this is Marks and Spencer, and this is the next. Okay, so what you do, Control F, type there income statement. So you will see their consolidated income statement on the page 115. So we can go through state page. So I can quickly, maybe it's not exact 115 because some extra page is there. So you can look around further. It should be underneath all these accounts. So these are there. This is the income statement of next. So look there, the last year, the revenue and the sales, what's happened? Last year, this year, it's been increased. The cost of sales, what's happened, is being increased. What's happened, the gross profit is increased. And other distribution, because this was prepared under IES 1, you will see their major two heading, distribution cost and admin cost. So then other gains we have, and then we have a trading profit, and then they found finance cost and other income tax, how much they paid and what they have. Last year, this year is slightly dropped, and it showed how much dividend this year and the last year they paid. to the shareholders. So please, it's good to be look around. Then we look around the consolidated mean the group. They have a parent, subsidiary, and associate. So what is the structure of the companies? If it's a companies, so guys, it's good to be remembered. So first, parent company. Parent company. If you own it other company more than 50%, you are the parent. Subsidiary. Subsidiary. So we need to be look around the subsidiary company. So if you own it 50% or more, you have a control as a parent. It's your subsidiary. From 20 to 49% if you own, is called associate company for the parent. And then if you own, if you have an investment less than 20%, this is called your simple investment. Yes. So you can call this is my investment in that company. You can't call associate or so consolidated. We prepare their accounts to reflect in our accounts as well, because as a parent, next is a parent, they have different subsidiary and associate companies. So that's what we call consolidated group and the consolidated statement. So we have non-current assets, which is a long-term asset. Is what's happened last year has been increased. Current asset, the asset which is also known as the liquid asset, near to cash or cash itself. So it's last year, this year is increased. Then we'll look around the current liability, which was supposed to be settled, this went up. And if you look the total liability, this went up from the last year. If you look the net asset, the last year and this year is increased, and we look the net asset always equal to the equity figures which is given here. And if you want to be detailed equity, you can go in the chain equity at the start of the year and end of the year. What's happened equity figure, that was 553 now, and it was 591 from the start of the year. So we can look around. Then cash flows under operating activities, look the cash, what's happened last year, this year, the net cash is increased under operating. If you look under financing, the cash outflow is more compared to the last year, and the cash under financing activities is went out from the business because we settled the liabilities. And now we look at the last year with the cash balance was the negative, now we have a positive, and overall we have a positive 34 million cash, the balance in the next. So this is the way we can analyze, we can compare with the Marks and Spencer. So I copied the Marks and Spencer for you, so you can look around and you can compare. When you do your assignment, it's good to be look around and compare and assess, the which one is performed better. And each, the notes, like, we're supposed to discuss the notes. If you look here in each financial statement, if I'll go back to we've been given the notes, 19.6. So look your notes, so if you want to find the revenue where this came from, go please note 1 and 2. If you want to be impairment, the asset, how much revalued, go on this is this, if you want other gains, other incomes, so you can read these notes. These notes is given within the statements. Yes, so please you can read. So if I'll go back to, I'll type here note 1. So we can go through the notes. You will see there notes 1, online customer and receivable area need to be hedge accounting. Yes, so these are the notes we've been given, so we can read all these notes. Yeah, and we can get better understanding about the company. Okay, so we learn about today how many types of types of ownership. If you want to start a business, how we can, sole trader, partnership, limited company, and charities as a non-profit organization. And the manufacturing can be, it's part of, as it can be a sole trader, partnership, and limited company. You can start as a manufacturing companies as well. Okay, then we discuss about how many types of statement. We learn 4 types of the statement we prepare. We discuss about if it's a sole trader, partnership, and limited company, how the statement look like will be, and we discuss about how what sort of the international accounting standard we need to be follow and how we can prepare these statements. So all was today lesson. If you have any question, please drop me email on my email address anjum@ukversity.co.uk. Thanks for attending and listening this lesson if you have, and I hope we'll speak you all in our next lesson, in lesson 2, where we'll go through LO2 under the unit 2 and we are doing HE level 4 extended diploma in accounting. Thank you. Bye bye.